So what if I told you that intentionally diluting a company's stock, like initiating a directed share issue that undeniably cuts the equity pie into way smaller slices, is sometimes presented as this, exact secret password needed to unlock a multi-billion-dollar valuation?
I mean, it sounds completely counterintuitive, right?
Right. But welcome to this deep dive. Our mission today is to, well, decode a highly concentrated, honestly incredibly aggressive piece of financial commentary for you.
Yeah, we're looking at a pretty dense excerpt referencing a Reuters report, right?
Exactly. It's about a company called Sivers, trading under the ticker symbol SIVE. Okay, let's unpack this because whether you're a hardcore market watcher or, just curious about how tech companies scale up, the entire text we're looking at today is just a masterclass in how financial narratives are built.
It really is. And I think we need to establish the perimeter for this analysis right up front. Because look, the source material we are examining is built on very strong, highly speculative market projections.
Yeah, they use words like parabolic.
Exactly. They explicitly predict a parabolic write-up, and they just casually throw out a $2 billion valuation target based on this really specific sequence of recent events. So, our objective here for you listening is strictly analytical.
Right, we're not telling you to go buy this.
No, absolutely not. We are reverse engineering the mechanics of the author's argument to understand how financial momentum is sort of manufactured on paper. We are not endorsing these projections. We're not taking a stance on the company's actual enterprise value. And, this is absolutely not financial advice.
Right, we are simply neutrally decoding the anatomy of a super bullish thesis, dissecting the machinery of the hype, basically.
Which is fascinating when you actually look at the parts they're using to build it.
Yeah. So let's look at the immediate catalyst the author uses to anchor this whole thesis. They point to a maneuver happening right now. It's a 2.5% capital raise. And the author frames this as a, quote, highly bullish event. They quote the official release, which says the directed share issue comes from a limited number of Swedish and international institutional and other qualified investors.
Right.
But, I mean, anyone watching the markets knows that issuing new shares dilutes the current pool. It's just math. It sounds like Sivers is basically paying a massive cover charge to get into the ultimate VIP room, which is the US NASDAQ queue.
That's actually a really good way to put it.
But the text calls this 2.5% raise highly bullish. But usually, issuing new shares dilutes the pool. So why is the author spinning this as a universally positive thing?
Well, what's fascinating here is that interpretation hinges entirely on the designated use of the capital. So according to the text, the specific purpose of this raise is to likely fund regulatory and audit requirements for the listing.
Okay.
So the author's arguing this isn't just operational runway to keep the lights on or pay rent.
Right, it's not a desperation raise.
Exactly. It is a strategic capital deployment engineered to alter the company's financial geography. Because, preparing a foreign-listed company for the US NASDAQ queue requires an intense, super capital-heavy restructuring.
Oh, I bet.
You're paying for armies of specialized legal counsel, comprehensive PCAOB, compliant audits, underwriting fees, all of it.
So you really are essentially paying the high-stakes VIP cover charge to enter, the most liquid capital market on the planet.
Basically, yeah.
But if the goal is to attract U.S. investment, why go through the friction of an uplist at all? Like, if a company has world-class technology, institutional funds can technically just buy shares on a foreign exchange.
Technically, yes. But practically, the institutional plumbing of global finance doesn't really work that smoothly.
What do you mean by plumbing?
Well, many large U.S. asset managers, pension funds, these big institutional vehicles, they operate under really strict mandates.
Oh, right, all the red tape.
Exactly. They face massive compliance hurdles, currency exposure limits, and, crucially, liquidity minimums.
Okay, so they can't just buy whatever they want wherever they want.
No, not at all. If a U.S. fund wants to take, say, a $50 million position in a company, they need a market with enough daily trading volume to absorb that order.
Without the price just completely spiraling out of control because they bought up all the available shares.
Right. So they need the massive liquidity pool that the NASDAQ provides just to execute their standard block trades.
Wow. Okay, so the author's premise is that the NASDAQ listing removes that structural and geographic friction. Like, the demand to invest in Sivers might already exist, but the capital is just bottlenecked by the constraints of the smaller exchanges.
Precisely. The uplist is the valve opening. And that actually brings us to the second pillar of the author's logic regarding this 2.5% raise, which is the cap table signaling.
Cap table signaling. Oh, right. Because the text heavily emphasizes that the buyers of this new paper are international institutional investors. Like, this isn't just a retail offering on an app.
No, it's big money. The author is leveraging this concept of institutional validation. When sophisticated money takes a targeted stake right ahead of a major exchange move, it basically broadcasts a massive signal to the broader market.
Like a stamp of approval.
Exactly. It suggests that these funds have conducted deep due diligence, they've looked at the audit prep for the NASDAQ, and they've deemed the risk-reward ratio favorable.
Okay, so the argument is that the long-term value unlocked by this institutional backing vastly outweighs the short-term mathematical dilution of a simple 2.5% raise.
That's the argument they're making, yeah.
But I mean, let's be real, those institutional funds wouldn't swallow that dilution just to facilitate an exchange listing. Like, the listing is merely the vehicle, right? The payload is the underlying business.
Absolutely.
And that is where the source text makes its really aggressive claims. Because the author doesn't just call Sivers a tech company, they explicitly define them as a, quote, laser supplier.
Right, which is very specific.
Super specific. And furthermore, they link Sivers to some massive heavy hitters. They specifically name Marvell, ticker MRVL, and Jabil, ticker JBL.
Yeah, and this is where the financial mechanics really intersect with the actual hardware cycle. The author anchors the entire valuation thesis on a single, highly specific technical metric mentioned in the text.
Yeah, let's clarify that metric because it really is the crux of the author's narrative. The text highlights this massive event over the last 3 days. It literally says JBL 1.6T to use SIVE.
Yeah.
And I think when you read 1.6T in a financial context, the instinct is to assume trillions of dollars, right? Like a market cap figure.
For sure, everyone thinks money first.
But in the world of silicon photonics and data center architecture, 1.6T actually means 1.6 terabits per second.
Yes, and if we connect this to the bigger picture, that is the critical technological distinction driving this entire thesis.
Right, because we are talking about the actual physical limits of data transfer. I like to think of it like this. If companies like Marvell and Jabil are the ones mining for the future of tech, building the brains of next-generation AI data centers, then Sivers is the one selling them the highly specialized laser pickaxes.
That's a great analogy, because AI clusters, which are heavily reliant on just thousands of interconnected GPUs, they process information so incredibly rapidly that traditional copper wiring literally cannot handle the bandwidth.
Wait, really? It just fails?
Yeah, it literally melts or loses the signal completely. At 1.6 terabits per second, you have to use LITE. You have to use highly specialized lasers to allow these massive server racks to talk to each other.
That's wild.
It is. The transition from copper to optics is arguably one of the most significant infrastructure shifts in modern computing. The power consumption and heat generation of AI workloads have just hit a physical wall.
And so silicon photonics, where they integrate lasers directly onto the silicon chips, that's the industry's answer to that wall.
Exactly. So by positioning Sivers as the laser supplier for a 1.6 terabit ecosystem and doing it with a manufacturing giant like Jabil, the author is placing Sivers at the absolute epicenter of the AI hardware supercycle.
Wow. Okay, that reframes the timeline the author presents, because the text argues that once Sivers is on the NASDAQ, US institutions will likely be piling into the laser supplier for MRVL and JBL.
Right.
The narrative basically implies these massive funds are just desperate for pure play exposure to this 1.6 terabit optical transition, but there are very few publicly traded companies that purely supply the fundamental laser components.
Which perfectly explains why the author weaves the institutional validation from the capital raise together with the Jabil partnership.
Oh, I see.
It builds this compounding thesis, right? The tech is verified by the Jabil use case, and the financial pathway is verified by the Swedish and international institutional money funding the NASDAQ move.
So they're stacking the validations.
Exactly. The author is suggesting that U.S. funds are watching this setup. They are fully aware of the 1.6T bandwidth bottleneck, and they are literally just waiting for the NASDAQ liquidity gate to open so they can just deploy massive capital.
Which brings us to the real crescendo of the text. Because the author takes the catalyst of the capital raise, layers on the 1.6 terabit hardware thesis, and then synthesizes a set of staggering projections.
Highly aggressive projections.
Yeah. The text claims Sivers, quote, looks like it should be valued at $2 B plus soon, based on today's fundamentals.
$2 billion.
$2 billion. And then they assert we are likely going to see a parabolic write-up from the news. And then they deploy the ultimate closer saying we're witnessing the birth of the next LITE, LITE.
Yeah, and look, those are not arbitrary word choices. That is the deployment of aggressive psychological engineering.
Okay, let's break down that engineering because, so what does this all mean? The author lays out a rapid-fire 3-day timeline. They literally use text arrows. It's like arrow, Jabil 1.6T to use SIVE. Arrow SIVE secures new institutional investors. Arrow SIVE looks to be listed on NASDAQ.
Very punchy.
It is. Is this rapid sequence what fuels a parabolic projection? Because it feels like they intentionally compress the operational reality of hardware manufacturing and like regulatory audits into what feels like a 3-day sprint.
Well, yes, it creates narrative velocity.
Narrative velocity.
Yeah, the human brain naturally connects sequential data points and extrapolates a trajectory. So by stacking a massive tech partnership, an institutional buy-in, and an exchange uplist basically back-to-back,
yeah,
the author artificially accelerates the perceived timeline.
Making it feel like it's exploding right now.
Right, because a parabolic move in market terminology isn't just steady growth, It is an explosion in price that feeds entirely on its own momentum. It defies standard consolidation patterns.
So they want you to feel FOMO.
Exactly. The author is utilizing this rapid sequence to trigger an acute sense of urgency. The subtext is clear. The window to position yourself before the institutional capital floods, the order book is closing by the hour.
Wow. And to give that urgency a concrete target, the author bypasses standard valuation models entirely. Like, they don't offer a discounted cash flow analysis or, a forward price to earnings multiple to justify that $2 billion figure.
No.
Instead, they just drop a ticker symbol, LITE.
And that is arguably the most persuasive rhetorical device in the entire excerpt.
Really? Why?
Well, LITE is the ticker for Lumentum.
Oh, Lumentum. Right, a company that was basically an absolute darling of the optical networking and laser component space during the previous, telecommunications and 5G upgrade cycle.
Exactly. So utilizing Lumentum as a proxy is a textbook example of the anchoring heuristic. Right. The author knows their target audience. Anyone trading the optical or semiconductor sector knows the historical chart of LITE. They know exactly how aggressively the market rewards the dominant suppliers of next-generation optical components once a hardware cycle actually kicks into high gear.
Right. So by stating Sivers is the birth of the next LITE, the author doesn't have to explain the complex margin structure of laser manufacturing.
Nope. They simply point to a known historical winner.
It speaks directly to pattern recognition. The author is basically saying, look, you missed the ground floor of Lumentum's massive run, but the market is handing you the exact same setup in the 1.6 terabit AI cycle with Sivers.
Yeah.
It is an incredibly potent way to bypass analytical skepticism.
It effectively replaces mathematical modeling with historical nostalgia.
Historical nostalgia, I like that.
It's true, though.
Yep.
And notice how the $2 billion valuation claim is actually phrased. They say, based on today's fundamentals. The author is arguing that the market is currently mispricing Sivers simply because it is listed on a smaller exchange. The implication is that the company doesn't even need to execute flawlessly over the next 5 years to reach $2 billion. They just need to step onto the NASDAQ Q stage where U.S. institutions can efficiently price in the Marvell and Jabil relationships that already exist today.
Oh, that is a critical distinction. So the thesis isn't that Sivers will eventually invent something worth $2 billion down the line.
No.
The thesis is that the 1.6 terabit lasers are already worth that to the AI ecosystem today, but the market cap is artificially suppressed by a lack of U.S. institutional liquidity.
Exactly. Which circles us all the way back to the initial 2.5% raise.
Right.
In the framework the author has constructed, that dilution isn't a cost to the current shareholders. It is the tactical mechanism required to correct a massive market inefficiency.
Wow. Looking at the entire architecture of this source text, it is a formidable piece of persuasion.
It really is.
The author takes a verifiable operational action, a directed share issue to specific funds. They marry it to the most critical hardware bottleneck in the current tech landscape, the shift to 1.6 terabit silicon photonics in AI data centers. And then they wrap those two verifiable elements in a timeline of extreme narrative velocity, anchoring the final valuation to a legendary optical stock.
And that's why the discipline for anyone reading financial commentary of this caliber is recognizing where the data terminates and the narrative actually begins.
Yeah, where's the line?
Right. The Jabil partnership is a catalyst. The audit funding is a catalyst. But A parabolic trajectory. That is an interpretation of market psychology.
Totally.
The market is notoriously inefficient at pricing in complex hardware cycles, and the lag between a technology being validated and a company's revenue actually scaling up, I mean, that can take years, regardless of which exchange they trade on.
Yeah, I mean, you can manufacture momentum on paper in 3 days, but you definitely can't manufacture optical transceivers at scale in 3 days.
Precisely. The text compresses years of operational execution into a single impending liquidity event. And understanding the compression gives you the analytical distance required to evaluate the thesis objectively.
So as you process this deep dive, consider the dual forces at play in this text. You have the fundamental, undeniable shift toward optical computing in data centers, and then you have the purely mechanical flow of capital seeking efficient access to that technology. It's a 3-day whirlwind they've presented, from securing a massive use case with Jabil, to bringing in Swedish and international money, to funding the regulatory requirements for the US NASDAQ listing.
And which leaves us with a critical dynamic to consider whenever you analyze a company scaling rapidly like this.
What's that?
Well, when a narrative claims an impending valuation explosion, ask yourself this. How much of that projected market cap is genuinely derived from the physical nuts and bolts of the technology like? Actually solving the 1.6 terabit data bottleneck? And how much is driven purely by the removal of institutional friction?
Right. Does unlocking the liquidity of the NASDAQ suddenly make the underlying lasers more valuable, or does it just finally allow the market to weigh them accurately? That is definitely something to keep in mind the next time you see a seemingly basic capital raise framed as the catalyst of the decade. Thanks for joining us on this deep dive.